Welcome to this segment of the video seminar series. We're going to be discussing issues associated with portfolio management and particularly the basics of portfolio planning and construction. These are really fundamental topics. This is a short segment with particular attention paid to the investment policy statement and all the factors that are going along with the overall investment policy statement. And then, so what is this investment policy statement? Well, I think you've undoubtedly heard about IPS, and some people kind of think about it. Some people don't even use the idea of an investment policy statement. They just say IPS. Okay, what it means really, that's what it is. But what the IPS is, it's a formalized statement of who, what, when, where, how dollars get invested, who does investing, what the portfolio manager can invest in, what are the objectives of the client, and it just also identifies specific characteristics of what type of process you're going to be following whenever you make investments for the client. It is a formalized document. What does that mean, formalized document? It's written down, you write down and you include the investment objectives and constraints, a clear statement of the investor or the client's risk tolerance, what type of discipline on both the client and the manager, and what's meant by that is that the client is responsible for some certain ideas and concepts and topics, like keeping the portfolio manager informed of changes in their individual situation. When the manager has certain ideas that they have to, certain issues that they have to take care of, formulating a performance review, scheduling when that performance review is going to happen, etc. And there's also an idea as to whether or not, or at least coming up with a evaluation type of period whenever that states that, or at least provides some evidence as to whether or not the portfolio generated or did what it was supposed to. And in order to be able to do that, you have to have a benchmark portfolio that's going to be consistent with the investor circumstances and the investor preferences, so that the portfolio, if it's deviating from the benchmark, it's probably deviating from the portfolio, from the client preferences and the client expectations, objectives, and constraints also. All right. So what are some of the major components of an investment policy statement? Well, there's a description of the client circumstances. I mean, this is what are the circumstances on the client? What is it that the client needs? What's the purpose of the investment policy statement? What is it supposed to do? What objectives is it going to help us attain? Duties and responsibilities of all partners. There's the who, the concept. As I indicated in the previous slide, an investment policy statement is a formalized document that pretty much states who, what, when, where, how, that kind of situation. So the responsibilities here are on the who side. The procedures to update the investment policy statement and resolve any kind of problems that come out. There's an issue associated with how and when, interrogatives that we need to be dealing with. Investment objectives and constraints, we're going to get into those a little bit, but those are associated with the what of the investment policy statement, what's it supposed to do, what's it supposed to accomplish. These investment guidelines, what they can and can't invest. Again, there's always these issues associated with what is it that they're supposed to be doing. Evaluation of performance of the portfolio could be relative to some benchmark. Usually it should be relative to some kind of benchmark or some kind of bogey that should be connected to the individual investor up front. Because why? Because if you deviate from the benchmark, you're probably going to be deviating from the investor's objectives and constraints. And then there should be a bunch of appendices, a bunch of supporting documents that are connected with some of the implementation issues, the hows, the whats, and the whens, issues associated with strategic asset allocation, deviations, and rebalancing issues, which we'll talk about a little bit later. So when we talk about investment objectives, what is it that we are what is it that we are discussing here? Well, objectives are nothing other, from an investment policy statement, is nothing other than a formalized statement of the risk and return objectives for the investor. This is very important because risk and return is a trade-off, right? You have to realize, or the client and the portfolio manager needs to realize, that risk drives return. Fundamental paradigm in finance, okay, risk drives return. And if you do not understand that, that there is a trade-off. The more risk you take, the more return you expect to generate, but the more risk you take, the greater the opportunity of loss. So that's somewhat of an idea. This fundamental trade-off this trade-off is very fundamental to having a specific document and formalized statement related to the risk and return objectives of the investor and what the portfolio should be generating. Now, when we talk about risk tolerance for the investor, there's some psychological and personal factors, and when we think about psychological factors, those are related to what the investor likes and what they dislike, what they feel comfortable with, what they don't feel comfortable with. And in a minute, on the next slide, we're going to talk about this concept of willingness and ability to tolerate risk. And the psychological factors are mainly connected. Now, this isn't an absolute statement, but mainly we connect the psychological factors to the willingness, okay, to bear risk or have an impact, have a bearing on risk tolerance, and the personal factors is more related to the ability to bear risk. And those personal factors are going to be age, family situation, existing wealth. I mean, there's a bunch of different factors that could come into play there. Existing portfolio, how the wealth was generated, etc. Those are connected more with ability. So if we go directly to the risk tolerance factors, okay, and its ability and willingness perspective, as I indicate on that last slide, when we talk about ability to bear risk, all right, these are what? This is going to be more specific related to the personal factors of the investor. I mean, this is the investment horizon, what kind of income the investor has, what kind of liquidity they need, the financial responsibilities that I have, etc. And the willingness is really based on some of the psychological factors, these attitudes, okay, these attitudes they would have. So when we formulate a statement that they might be able to take a lot of risk, but they're not willing, on which side do we fall? Okay, which side do we fall? Well, the general rule of thumb is to go from a risk tolerance, a formalized statement of risk tolerance at the end of the day should be going with the constraining factor. What I mean by should be going with the constraining factor is that if an investor's willingness to take risk is greater than their ability to take risk, meaning they might be willing to take on a lot of risk, but financially they just can't do it. So you should be going with the ability, i.e. the constraining factor. Okay. On the other hand, if they're able to take on risk, but they're not willing to take it, right, you should still go with the willingness. Because you don't want to change the personality and psychological characteristics of your client. I mean, that's where the uniqueness of the client comes into play, right? I mean, you can't change their personality. I mean, I don't know. Maybe I guess you can. I just don't know how. But the bottom line is that you should be, at the end of the day, the overall risk tolerance for the investor should be based on the constraining factor, the one that is the least, if you want to think of it that way. And so when we think about these constraints, all right, what are the specific constraints? Well, they're legal, liquidity, time horizon connected, associated with taxes, and unique characteristics. To me, there's lots of different mnemonics here out there in the marketplace, but I have always used to remember the constraints that help me determine the overall risk tolerance of an investor. I've just used the mnemonic LUT for liquidity, legal, unique, taxes, and time. When we talk about liquidity, really what we're talking about is the potential need for cash. I mean, you need to have some, available to you, right? So that if you need it, you can go get it, right? Legal and regulatory, this is going to be more connected to institutional investors, not necessarily for individuals. not necessarily for individuals, unless we have something associated with some retirement accounts, some insurance accounts, or something like that. Then there are some specific regulatory issues and legal considerations that we have to formulate within the investment policy statement. But generally speaking, an individual can do whatever they want. An institution, however, may have certain promulgations that they have to operate within a certain box. Taxes, is the investor taxable, or is it tax exempt? Is it an endowment, is it a foundation, or is it an individual? And by definition, endowments and foundations, if they're tax exempt, they should not be investing in tax exemptable securities because they have the lower returns. On the other hand, an individual investor might have a tax deferred account, which allows for certain particular investments that would not allow whenever you're fully taxable, that kind of situation. Time horizon, I think generally speaking, I mean, the general rule of thumb is that the younger you are, the more risk you can take, the older you are, the less risk you can take. Well, but that's all relative, right? And it's all related to what? The unique needs and preferences and willingness characteristics, psychological profile of the individual investor. So I like to think of it, whenever the investment policy statement said formulate objectives and constraints, the objectives was first and the constraints were second. Well, to me, the objectives, the constraints drive the risk, which drive the return. So maybe it's a good idea to focus simple blocks, building blocks early. Get a handle around, when you're formulating an investment policy statement, get your hands around the investment constraints of liquidity, legal, unique, time, and taxes, and then use those to get an indication associated with the objectives of the investor, so that you can incorporate both I guess I would say hard items and soft items, or personal items and or qualitative items and quantitative type of items. All right. When we think about strategic asset allocation really should be this long term. You think long term when you think strategic asset allocation. And that generally speaking, the portfolio is going to have exposure to these various asset classes. The problem is that whenever you're coming in, whenever you're trying to formulate asset allocation, you need to know what? You need to know risk, okay? You need to know return, you need to know correlations, covariances, etc. And so in order to be able to do that, you should have those, okay, you should have those data available to you in front of you so that you can formulate and you can generate a specific formalized statement as to what exposures to each one of these asset classes your overall portfolio would be allocated. Now, when we think about asset classes, all right, when we think about asset allocation, when we think about equity, think about debt, sometimes those aren't as clear cut as you think about it. But at the end of the day, when we're talking about asset classes, what you should have here is that you should keep in mind is that within an asset class, correlation should be high. Okay, across asset classes, between asset classes, correlation should be low. And so from that aspect, whenever you're trying to allocate between equity and debt, you probably should be looking really at equity, and you shouldn't be looking at debt that's acting like equity. And you say to yourself, well, what is that? Well, that could be a high-yield bond. It could be a convertible security that really should be converted, or something like that. Only because standpoint, even though it might have that label, it behaves like other securities in the asset class. By definition, it probably isn't. It's probably a piece of equity. Okay, so here's an example. Okay, here's an example of a strategic asset allocation, structuralized, formalized statement about specifics of what we're going to invest in. All right. So essentially, we have what? We have we have cash. Okay, and every allocation should have cash because we need access to liquidity sometime. Okay, we have essentially equity here. This is going to be equity here, which is approximately 42%. Okay, even though we're breaking out equity between large cap and small cap, large cap and mid cap. Okay, mid to small, SMIDs. Okay, and then international and in emerging markets. So there should be within this equity class, we should have a pretty high correlation, but between these, maybe there should be a little bit less. But if you think about it, the correlation, okay, the correlation between the equity. All right, this is 42% equity, okay, and then this is bonds, okay, and this is bonds, and how much did I calculate that to be? 39%, okay. what you should recognize, what you should recognize is that the correlations between these two particular asset classes, and I don't mean each one of those items here before, but generally speaking, this 39 and 42% should be lower than the correlations within the overall equity piece and the overall bond piece. And then we have down here on the bottom here, we have and I'll just put this in quotes. Alternatives approximately 17%. So what you should recognize is that when we're talking about asset allocation, I mean, what is this? I mean, this is how much of the investor's portfolio we're going to be investing in each asset class. And we should be fully invested. And you say to yourself, well, you're not fully invested. You've got some cash. Yes, you need some liquidity aspects. But the idea is that we should be investing, and the cash should be a component of our overall asset allocation. Now, remember, this is strategic. Okay, this is strategic asset allocation, which essentially means what? This is our long-term exposure. That doesn't mean that at every point in time we will have this particular exposure, because there's some tactical flexibility that we should build in, that we kind of mentioned in the investment policy statement description previously, that we should hold, or that we should be able to allow for deviations. Okay, and we should allow for deviations. So whenever we, formulating and documenting and writing down the investment policy statement and have everybody agreeing to it is one aspect. Then you actually have to do what? Then you actually have to implement. You have to invest in something. That's the idea behind an investment portfolio, right? And whenever we're talking about portfolio management, I mean, we have to manage a portfolio. What does that mean? We actually have to invest in a portfolio so we can see it before we can manage it. So from that aspect, we actually have to construct an overall portfolio. So we would use some of the foundations that we've seen and presented in the portfolio management area about risk and return, both parts 1 and part 2 of those segments of the video series. And that the standpoint is that we want to be able to construct and at least choose assets that are efficient, i.e. assets that generate the highest return per every unit, per every level of risk that we're willing to take. And once we see that frontier, and once we see those optimal securities, efficient securities, then we want to be able to choose an optimal portfolio based on what? Based on the objective constraints from the investment policy statement. All right, and those objectives and constraints can help us formulate a strategic asset allocation that we can choose that optimal portfolio. But yet, we should realize that tactically, right, we should allow deviations from that strategic asset allocation, from time to time, to take advantage of possible mispricing, take advantage of different factors in the marketplace, changing economic conditions, etc. So that tactical asset allocation allows for flexibility. It doesn't mean, if you think of it this way, if the tactical asset allocation becomes the primary decision and we're always deviating from it, maybe there's a problem with our strategic asset allocation. And then finally, we might want to also consider some issues associated with risk budgeting. Allows us to do what? Allows us to take into account some risk considerations to both our strategic asset allocation decision, our tactical asset allocation decision, and our security selection decision. I mean, ultimately, at the end of the day, what do we have to do? We have to buy individual securities. And those individual securities, whether they are representative of overall indices or not, we still have to make the purchases, and therefore they should fall underneath. And fall within our overall objectives and constraints for the investor. So that's very, very basic, short segment, but short segment in the portfolio management arena, with particular focus on some of the issues and particular attention that you need to pay for the investment policy statement.